The date is Wednesday, June 11th, and my name is Kevin Kleinman, owner of Stockhaven.com and Watchhimtrade.com. This is a free webinar in which I am answering questions submitted by users of each site. So the first question I received was, is there a definite season for sub-penny stocks to typically run? Because there doesn't seem to be hardly any sub-penny stocks running right now like there was in the fall or winter here into the spring. And the answer is, to me, there are two best bet times of year, meaning that if you had to ask me when do I think the market's going to be hot in the sub-penny market or the penny stock market in general, I would give you two time frames. Number one, the period from Labor Day to Thanksgiving, so the fall. And then number two, the start of the year from January until February or so. Tends to slow down in March, it seems. Regardless of seasonality, though, you're not going to see sub-penny stocks get hot without the overall penny market being hot. So what you want to look for then is the penny market to heat back up. But how will you know that the penny market is heating back up? Well, it really takes a stock to come on the scene like PHOT. PHOT, you know, the weed stock, and I'll just show a chart here. Back a few months ago, you could see PHOT was trading tons of volume, and it made a huge move starting below 10 cents and just a really nice uptrend before, you know, topping out in March. But so when PHOT really got going, look at when it was. It was right at the beginning of the year, okay? And then prior to that, you also had PHOT start to make a move from 3 cents on up to 10 cents between that time period I was talking about, Labor Day to Thanksgiving. And that was really the best time of the year for the penny market. Once PHOT got halted and, you know, really once it started declining off of that high in March, you started to see the penny market come down. There was other signs as well that the penny market was losing some steam. You take a stock like Fannie Mae, FNMA. Fannie Mae, you know, beginning of the year into February makes just a really big move from $3 on heavy volume down here, okay? And then also you go back and you look at that time period between Labor Day and Thanksgiving. The stock made a nice move up from under $1 to over $3, again, on heavy volume. All right, so when those two stocks kind of died out and lost momentum, that's when the penny stock market kind of died out and lost momentum as well. And you really haven't seen it come back. So you want to see a stock like PHOT. I'm not saying it needs to be PHOT, but you need to see a stock pop up in the market that is trading similar to PHOT. Lots of volume, dollar-wise, and lots of really good percentage movement where a lot of people can trade it. All right, and moreover, you need to see it get sustained. Okay, you can't have a move last a day. There needs to be a move in the penny market that lasts a week and then 2 weeks. And also, it needs to be a move that doesn't seem to be at immediate risk of an SEC halt. We saw a promoter come out, I don't know, a couple months ago, seemed like maybe they had a promising pick, but I know that we were saying in the chat room, this thing's going to get halted and be very careful. Sure enough, within a week after an initial good move, it got halted. So it needs to be a stock, you know, ideally that isn't getting heavily promoted. You know, it's kind of moving on its own merit, like PHOT was thought to be with the popular sentiment surrounding the weed sector. So we need to see something like that show back up. That's when traders in the penny market will start to look around for other stocks that might be primed to move. And when everyone starts looking, if one starts moving, the action kind of becomes self-fulfilling. You think about ERBB, GRNH, LATF, all of those plays ran because of the idea that this one could be next. And once that this one could be next mentality takes over, people pile into a particular stock, and sure enough, it does become the next mover. The problem is trying to time when that mentality is going to take over, because it's all about dollar volume. So that's why I say look out for something that shows up on the scene in a big way with big dollar volume and a sustained move to signal that, all right, this one is next. And that's when the liquidity is going to come back into the penny market. You're just not seeing it right now, and as a result, you're not seeing anything from sub-penny stocks, and you're probably going to see movement in the broader penny market before you see movement in the sub-penny market. So if the seasons coincidentally happen to be once again after Labor Day or at the New Year, then that's the way it is. But regardless of seasonality, it's all about liquidity and sentiment, and right now there is neither in the penny market right now. So, I don't think you see a sub-penny stock pop up really soon. Next question. This is probably the best question of the webinar, or maybe the best topic to discuss. I was reading an article that talked about timing reversals. The article said that everyone thinks you want to focus on major congestion areas of support or resistance as a means for timing a reversal, but that isn't what you should do. Instead, the article suggested focusing on areas of very little price action to try and time reversals. I was rather confused by the concept. Could you please shed some light on this? All right, I did read the article myself, and I believe what the author was trying to get at is that reversals happen when people least expect them, and from prices that weren't necessarily charted on the chart. The best way for me to explain my own interpretation of the article is with some examples. So I've picked out some that I think illustrate the point that the author is trying to make. So we're going to use big board examples for this. First one will be from Netflix. All right. So look at the beginning of the year on Netflix. All right, we're looking at 2014, okay? You see that the stock made a little dip down here and found some support right around 320. All right, and then you had just a really big move back up, okay? So after that rally off of 420, off of the rally off of 320 and move into the new all-time highs in the 400s, this is what Netflix looked like, okay? So if I show you the chart up until March and asked you about Netflix's most critical support levels moving forward, you'd probably focus on, this area here around 425, 420 or so, and then you had some lows here right around 400, and then from there would be two levels that really stand out to me. And I was talking about this at the time with people when Netflix did start to fall. It was this level here, the base of this gap up, okay? You've got this gap up space in between here. That was right around 370, all right? If you lost 370, there was really only one other support level that stood out to me, and that was that 320 mark. At this point, when Netflix is up here, you're saying, man, this stock looks really good. If it does start to pull back, though, there's no way it's getting to 320. And if it gets down to 320, then chances are something's really wrong and it's probably moving much, much lower, right? If you break down at 320, that was the year-to-date low, I expect Netflix to move lower. I'm saying I expect from the perspective of the average trader, who this article is talking about. So 320 was a key psychological reference point. So now, we'll stretch it out, and we see that Netflix did pull back, and it actually broke below 320. Now, based on what technical analysis teaches us, Netflix should have kept going lower when it broke 320. Yet instead, that was precisely when it bottomed. Right? You see, here we are. Here's the support line. You see the 320 tests. And you have this price action beneath 320. And lo and behold, the day Netflix went below 320 was the same day it bottomed. Isn't that the day that it was supposed to break down and keep going lower? And this is what the author's talking about. What I think of when I see that Netflix action relative to 320 is a quote-unquote max pain scenario, meaning that investors and traders can come into the market once 320 breaks, knowing that the majority of the market is likely looking for more weakness since Netflix just broke a key support level. That majority thinking creates a tremendous imbalance in favor of supply. The author used the term imbalance, and you can see evidence of that imbalance represented by the fact that on the day it broke below 320, it was the highest volume on a red day in the stock all year and in the last 6 months in general. You would have had to go back to October to see a higher volume red day. So that imbalance in favor of supply creates a potential trap for people who are bearish on Netflix, because if the imbalance reverses in favor of demand or fails to sustain itself on the supply side, the majority could find themselves on the wrong side of the trade. What happens when the majority finds themselves on the wrong side? Well, they scramble to the other side very quickly, and this then creates a surge in demand, which can lead to dramatic reversals, which is exactly what Netflix did, as it has since rallied from that low around 320, and it actually hit 300 exactly, all the way up now into the 400s for a very, very strong bounce. But back to the idea of a max pain scenario and how it relates to the traders and investors that are actually buyers on the 320 breakdown as opposed to sellers or people who are staying on the sidelines. People who are buyers on that 320 breakdown when the chart says don't be a buyer at all, they can come in to the market with a plan that says, okay, I know 320 is a key area, so as long as it doesn't stay below it consistently, that's a sign that sellers aren't as in control as they appear to be. So maybe you buy the 320 breakdown with a 5 to 10% stop loss, which would equate to about 305 to 288 in Netflix's stock. Your downside's 5 to 10%. Your upside, though, is a resumption of a stock that's in a long-term uptrend and is perhaps one of the best performing stocks in the market, which has also been very hard to get an entry in on. All right, so to put this idea of a max pain buying scenario, market timing strategy into a statement, I'll say this. My risk is lowest when the potential for me to be proven wrong is highest. My risk is lowest when the potential for me to be proven wrong is highest. Take the following hypothetical scenario. I'm watching stock ABC, and I want to buy it on a 5% dip. However, I believe if stock ABC drops 6%, it's then going to end up dropping more than 10% or more total. this should be a pretty common scenario for many of us. We look at a stock, we say it looks good, and it pulls back a little bit and it still looks good, so we take an entry. But sometimes it pulls back too much where now it looks pretty bad, right? And we end up thinking it's going lower. So when stock ABC is at that point where it's pulled back, I want to buy it when it's at the line of pulling back and still looking good, but about to cross over to pulling back too much and now looking like it wants to go lower. I said my belief is that if it drops 5%, it looks good, but if it drops 6%, now it's going to keep going lower in my opinion. So when stock ABC has dropped 5.9%, that is the exact moment I want to be a buyer, because I know that as soon as it drops another 0.01%, I'm getting out at a very small loss, because my idea behind the drop, buying a 5% dip, has been proven wrong. In other words, I took the trade when my trade had the highest potential to prove my idea behind the trade wrong. And as a result, that was when the risk behind the trade itself was at its lowest point. So I know that's a mouthful. Does that make sense? What I'm trying to explain, max pain market timing strategies. Buying when, it's about to break down, but if it doesn't break down right here, then it's definitely going to bounce. Because this is an important concept to understand, and it's a concept that will help you have better percentage gains on a consistent basis time and time again. I promise you. You will not be able to get those sick entries until you can eliminate the fear of being wrong, because the closer you are to being wrong, the lower risk you have when entering a trade, and you've got to understand that. So is there anything in that conversation that doesn't make sense? All right, seems like we all get it. So let's show some other examples here. And you can find examples, Netflix happened to be a good example recently, but you can apply the same thinking to a lot of stocks from April and May, because there was a market pullback during that time. So just pick a chart and look at it. You'll probably see it. All right, let's check out Priceline. We look at Priceline, similar to Netflix. Coming into the year, you had a little dip, and I see these two levels that really stick out to me on Priceline, and that is the low from January 6th at 1113 and the low from February 5th at 1103. I just call it the 1100 area. All right, Priceline goes on to bounce, and at this point in March, we see Priceline has made a nice move, and maybe we talk about some support levels. We say, all right, there's this one here, and then you've got a little gap here. But then, to me, the big one is around this 1100 area, just like with Netflix relative to 320. That was the year-to-date low. Psychologically, that's what I'm focused in on. Well, we'll just back it out here and take a look. And you can see pretty much in exactly the same way Netflix did, Priceline pierced below that key low. All right, it broke below 1100 here on super high volume, highest volume on a red day in months and months and months. So again, the exact same scenario as Netflix. You have an imbalance on the supply side. You just broke below a key support level. It has to go lower. Well, that's your max pain entry relative to 1100. Lo and behold, it ends up being the bottom on the stock. You're catching a bottom at 1100, and you caught a bounce all the way back up to 1300. All right, another example from Amazon. Amazon I'm looking at it here, right? And to me, there is this price level right here from October, the October low. You had to move down. It was right around 300. That was an area of some considerable price congestion in the stock. You then went on to make a nice rally higher. Okay, so I'm thinking about pullbacks. Amazon topped out in late March. No, actually Amazon topped out late January. It was falling before others started to fall. So just like the last two examples, we have this key support area which is right around 300. So you just show a trend line here. And Amazon in April and May breaks below that key support, super high volume, so we've got an imbalance in favor of supply, okay? But lo and behold, that was the exact time you wanted to be a buyer on Amazon, and now the stock is up at least 10% from those levels in the 330s. I'm not trying to make the point that it's easy to time these bottoms. They're only bottoms if they end up being bottoms, right? But you'll never get a bottom unless you try and put yourself in a position to do so. So I can actually proudly say I was buying Amazon in my IRA account in the low 290s here during this stretch of May. And my thought process for the position was, this is stock that's been beaten down, number one. I like the company, number two. Number three, yeah, it's below 300, but it's not too far below 300. And it looks like it just broke down, but how come it's not continuing to really sell off and go a whole lot lower? Just like Netflix and Priceline relative to 1100 and 320. And I ended up getting the bottom. And I can tell you honestly, that's the first time I've ever gotten a bottom on a stock, and it's because it's the first time I've ever put myself in a position to get the bottom on a stock, and it felt pretty good to be able to do that. So hopefully you can kind of use this technique as a strategy for timing some bottoms yourself. Now these have all been examples with bottoms and market reversals off of the bottom, not market reversals off the top. I personally find myself having an easier time applying this Max Payne thought process to buying bottoms than I do selling tops. Tops have a way of lasting longer than bottoms do, and that's why it's very important to have price targets and quote-unquote sell on the way up. So let's show some examples of tops lasting longer than bottoms to drive home this point. All right, you look at Priceline. Priceline topped out between February 25th and March 13th. And it wasn't one specific price really. It's kind of a cluster of price action, unlike the bottom was just at one price. We look at Netflix again. Netflix topped out between February 25th and March 7th. And again, it was a cluster of price action at an area, not just one specific price. And then lastly, using Google as an example, Google topped out between February 18th and March 11th, again, at a cluster of price action. What I want you to notice is while these tops did last longer, they still show the characteristics of the price actually exceeding expected resistance levels, only to then seemingly stall out just as it looked like they should continue higher. It's kind of the opposite of the bottoming price action, just for a longer period of time. Remember, Netflix broke 320 support. That's exactly when it was supposed to keep going lower. That was the level that should have triggered more selling. In fact, it ended up being the level that triggered a bottom. Priceline broke 1100. That was the level that should have triggered more selling. Instead, it ended up being a bottom. Amazon broke 300, 295 area. That should have been more selling. Instead, it ended up representing a bottom. You have the same characteristics here in the examples I just showed you on the top side. Priceline broke out at 1350. It should have kept going to 1400. Instead, that ended up being the top, but it just lasted longer. Netflix broke out above 450. That's a psychological level that, hey, now we're going to 500. Instead, topped out, represented a top for the stock, but it just took a little longer to play out than the bottom did. Google just broke out above 600 here in this price action I have circled. 600 is a psychological level where you say, all right, this thing's going to keep on going now, but again, stalled out and was unable to continue to rally. So I hope that these examples and my thought process help clear up some of your confusion regarding that article you read. All right, next question. Do you scrutinize losing trades harder or winning trades? I personally scrutinize any trade that I feel like I can learn from. Sometimes that happens to be a losing trade, other times that happens to be a winning trade. I really don't think I lean either way as far as focusing on losers or focusing on winners. If I'm having a winning stretch, then I'm reviewing my recent trades all the time, it's going to be more winners. If I'm having a losing stretch and I'm reviewing my trades all the time, it's going to be more losers. When studying losing trades, I usually find that I didn't get a good entry, and that led to poor execution throughout the trade. When studying winning trades, I usually find that I did a good job of being aggressive that was justified by price action. And you use the term scrutinize, which to me focuses on intense study and analysis of a specific trade. But I want to make the point that I study all of my trades every week. You can't pick and choose which trades you're going to study. All right. For sure, though, some trades get more attention than others, and that's what I was speaking to at the outset of this answer. I think naturally we don't question ourselves as much when we're winning as we do when we're losing. And that's something you see play out all the time in sports and education and just in your personal life in general. Parents don't question their kids when they're getting good grades, only when they start failing a course. ESPN doesn't bash LeBron when the Heat are winning games, only when they lose Game 3 in the NBA Finals. Trading's the same way. Are you more likely to search for answers coming off of the best trading week of your career or the worst trading week of your career? We all know that answer, all right? But that's why it's very important to study your trades all the time, not just your losers. Studying winners will help you identify skills that tend to show up in those winning trades, which will then lead to a greater likelihood of repeating those skills in future trades, which will then result in more winners. Also, on a somewhat related note, but not focusing on trade data itself, you need to consider external factors as well. Are you getting your usual sleep? Have you been hitting the gym like you usually do? Is there any distress in your relationships or personal life? Many times we reason our mistakes or successes with only the data that surrounds the trade, and we discount the influence that other factors in our lives have on our trading. And that's a mistake. You need to be in tune with your life when it comes to trading, because trading is a life. There's no separation of trading and career. When you have a job, a paying salary, you can have a fight with your wife at home and you can go to work, and as long as you don't piss off your boss to the point where you get fired, you'll still collect that paycheck by just showing up and doing what you're supposed to do. Trading doesn't work like that. You get in a fight at home, all right, and then you try and come sit behind this desk and make some good trades, it's going to mess with your paycheck. In fact, you might not end up with a paycheck. You might end up making the paycheck out to Mr. Market and having some debts to pay. So, don't just focus on what the numbers are saying behind your trades, where you entered, where you exited. Always consider, hey, what's going on in your life in general? Where are you at emotionally? Did you lose a loved one? Are you hitting the gym? What have you? Because those definitely play a role in your trading, and if you think they don't, I'm here to tell you you're wrong. Next question. Do you use a rating system for your trades, like a 1 to 10 scale? For instance, do you assign a 1 to a bad trade and a 9 to a great trade to help you keep track of how you have been trading? So for me, the idea of a rating system for your trades, it's interesting to me, but I don't use one myself. I really rely on how I feel about my trading more than anything. You know, there's times I make money on a trade, but I don't feel that great about how I executed. And then there's times when I lose money on a trade, like today I lost a couple bucks, but I feel pretty solid about my execution for the most part. All right. Now, if you're using a rating system and you find it helps you analyze your trades and leads to self-improvement, then I would certainly stick with it. Some people are very analytical and they like using numbers to measure performance, or in this case, perception of performance, because the way you measure performance itself is ultimately going to be your P&L. But like I said, you might have a trade that you didn't make a ton of money on, but it might be a 10 because of a super great entry and a super quick exit, and you really attacked various factors. Rating scales are completely subjective, and that's good. You are entitled to that, and you should do it if you have a level of comfort with doing it. For me, though, like I said, I'm just not for me. I'm more in touch with how I feel. I'm very psychological and really just rely on my mood. I trust myself to be very in tune with my emotions, so I don't feel a need to write down specific ratings for a trade. And also, all of my trading is recorded, and I re-watch footage of my own trading often. Every morning before the market opens, if I'm not reading a book that deals with trading or psychological impacts of trading, then I'm taking 15 to 25 minutes to watch trading footage from the day before, reviewing my trades from that day. And I'll talk to myself about a trade more than anything as I'm re-watching the footage. So that's kind of my own rating system, but I just don't use numbers. Next question. How are you trading around this low volatility environment, considering the VIX making a recently new 52-week low, and what is your general market outlook? Well, first of all, I'd like to say, and I'd like to think I'm being honest when I say this, I'm not doing anything tactfully different, really. I'm just trying to make good trades. Doesn't matter, high volatility, low volatility, trying to make a good trade. In a low volatility environment, though, as a rule of thumb, there's going to be less movement in the market, and less movement means less trading opportunities. So as a result, the total number of my trades I'm making per week has come down. You look at my trade numbers from the last couple of weeks compared to April, and I'm trading less on an absolute basis. Also, I'm more keen to that one good day or one good play. And what I mean is we seem to be in an environment where maybe once per week there is a particular stock that just makes an awesome move, as opposed to April when there was all types of movement going on. If we look at Netflix, you can see Netflix made this awesome move, breaking out above this resistance here and then breaking above 350 resistance, just a huge 3-week move or so from 360s up to 430s, right? And then after Netflix, it was Apple kind of broke out, and it's split adjusted now, but Apple made a really nice clean breakout above 600 for a while. It was consolidating right around 600. 86 is pretty much in line with that, and then you just got a nice clean move to the upside. And then just last week, we saw Amazon make a very nice move to the upside here in a matter of 2 days, going from 310 to 330. So I've tried to focus in and stalk a stock that I think is primed for a turn, not meaning a turn in direction, meaning its turn to make a big move. So for instance, right now, I think Google is one such stock. All right, so I'm watching Google closer than I usually do. I watch it every day, but I've really been watching it. And one of the things I've been telling Watchhimtrade subscribers is I think Google's either going into the 580s or going into the 550s really, really soon, because it's just kind of got this little consolidation. So, bottom line, I think Google's getting ready for a move, so I'm watching it close because I want to be sure to catch that move when it happens, because the market environment right now, it's not a quantity equaling quality type of environment, meaning that in April, May, you just look out broadly, and there was high quantity of stocks making high quality moves. Right now, you still have some high quality movement, but it's much more focused. All right, it's not broadly speaking, and you have to really be watching it and be ready for it, be prepared so that you know how to act. Now, the only thing that I am doing strategically different that I wasn't doing in previous low volatility environments is selling premium by shorting puts and or calls. Now, the irony is that premium is low in a low volatility environment, and the general teaching is that you don't short low premium. However, I'm just doing it for day trading purposes, so I don't have nearly as much risk as someone who's shorting premium, on an overnight or week-to-week basis. The reason I'm selling premium lately is because recently there's just no movement. You're seeing time decay really affect a lot of these weekly option strikes, and as a result, there is good money to be made if you can correctly identify a slow-paced trading day that won't have directional movement. Recently, and meaning very recently, like this week, Netflix has been a good example of a lack of movement. You see Netflix closed last week at 430. So far these 3 days, it's still at 430. So neither puts or calls have gone anywhere but down this week. You haven't had any direction at all, right? You look at Tesla. Tesla last week closed right around 206 or so. And so far on the week, it's at 205. So it's had some slight move down, but still puts and calls on a net basis have both gone down. You look at Google. Google closed on Friday at 566. Google here the last 3 days is still at 567, so it's moved $1 all week. That is absolutely killing any of the premium on Google puts and calls. So those are 3 stocks that have been good examples this week that, hey, if you're shorting premium on both sides, you are collecting money. But at the end of the day, I prepare the same way, and I'm always just looking to make a good trade with solid execution. In a high volatility environment, I'm going to have more opportunities to make those good trades, and I'll have more of a responsibility to really execute well. Okay, I'll have chances to redeem myself. In a low volatility environment, I have less opportunities, and I have a greater responsibility to get that trade right. Like I said, kind of stalking Google here for a move. But the important thing in an environment like this is to not force trades and to be prepared for when volatility does inevitably pick back up again, because it will happen. Now, as far as my overall market outlook, I think that number one, stating the obvious, the market's in an uptrend, and overall, I don't see any signs that that uptrend is on the verge of changing into a downtrend. That doesn't mean I don't think we can pull back. We're at an area on the chart, 1950, where I think it makes perfect sense to have some consolidation. And I'll show a couple areas at similar price levels over the last couple years where we have consolidated kind of every 50 points or so. So most recently, let's look at 1850. All right, if you just draw a trend line, or a horizontal line rather, at 1850, I mean, look how much consolidation occurred the first time getting up to 1850 in December of last year. All this churn action around 1850 before ultimately going down and then coming back up and going above it. And then even when you did get back above it, you still spent a lot of time churning around 1850. Okay, so that's just one example there relative to 1850. Wouldn't be surprised by the same thing happening at 1950. Now we go back and we look at 1750. All right, you got up to 1750 for the first time in late October, early November, and you see we spent a good 3 weeks at least kind of churning around 1750, and then when we did start to break and move higher, we eventually came back to back test it a couple months later. Now let's just put the trend line down at 1650. All right. Now we're going back in. What year are we in now? This is 2013. We got up to 1650 for the first time in late April, early May of last year. And look at this consolidation around 1650. Ultimately had to pull back, make another attempt above it, but couldn't really stay above it. Came back down to it in September, made another push, then came back down to 1650, held it as a low, and boom, then we were finally off to the races. But I mean, you hit 1650 for the first time in May 2013. You didn't really make the solid move off of it until October 2013. And lastly, let's look at 1550. Okay, so you got up to 1550 in about March or so, and look how long we consolidated on 1550. I could just keep going back and show you the same thing at 1450, 1350, so on and so forth. Bottom line, it makes sense to, if not pull back, at the very least have a healthy consolidation here and be in somewhat of a churn environment. So that's number one. We're in an uptrend, but I'm not expecting immediate term upside from here because of the fact we've made a good move and we've gotten to a price level that historically over the last few years, these midpoint marks between hundreds, 1900 to 2000, 1950, 1800, 1900, 1850, I just showed you guys, have caused pauses in the market, but they haven't caused absolute downturns or reversals of the uptrend. So I guess you could say my market outlook is expecting consolidation in the immediate term, possibly even a near-term top, but overall there isn't a reason to be bearish outright, and I think that the market does continue to make new highs. If you just go back in the market's history and look at its price action since its inception in the late 1800s, you'll see that the market has never failed to make new highs over its history. So, I'm not one of those Mr. Gloom type of people. I do expect things to continue to be a low volatility environment, for the next few weeks, but I think we could see some volatility here this summer just because that's the way it usually does work out. All right, now I had one chart request to go over. and it was for ticker INVE. You can see I've got it pulled up here on my screen. So just looking at the daily, there's nothing that I get too excited about on this chart. It just has kind of been in a channel here where the low end has been around $6 and the top end has been around 10 to $11. For me, watch $10. You're coming up on it. Just psychological. Needs to start establishing itself over $10. You can see there's been 2 instances so far this year where it's tried to get above 10 and hold 10, but it wasn't able to do it. So until you see it get above 10 and sustain movement above 10, then just wouldn't really get interested in INVE. And really it might be a short trade here versus that $10 range. But volume is very low, so it's a low volume mover. You have had a nice move off the bottom, but just, I think there's better setups out there personally. And if you go back and you look more historically at a longer term weekly chart, you'll see that this stock has been in a downtrend over the last few years, and certainly has some work cut out for it to the upside. But simple setup, needs to get above $10. If it can get above 10 and hold 10, then you could see some serious upside. But until that happens, I would expect a move back down from here based on its recent channel history. All right, and that was all of the questions that were submitted and chart requests. Are there any questions on anything I went over? Again, I'm not, unfortunately you had to have submitted your question. In the email you guys get sent about these webinars, you should see, a sentence that says, please submit your questions by 7:30 Eastern, the day before the webinar, or the night before the webinar. And the reason that is because I prepare these answers. I'm not just rattling off answers off the top of my head. I'm really looking at your questions and giving heartfelt, insightful answers to you guys. Could you apply your strategies using the DOM? I'd have to know which strategies you mean, first of all, and what DOM means. So could you apply my strategies using the level 2? Again, I still don't really understand what you're talking as far as strategies. I mean, I use level 2. Level 2 is 70 to 80% of my trading. Level 2 and depth of market depth, I believe, is the same thing. I'm always using level 2. If you go on my YouTube channel at Watchhimtrade, you'll see some level 2 trading. I'll use a chart sometimes to pick out price points, but when it comes to actually getting in the trade and executing the trade, it's all about level 2 action and time and sales. So follow up on INVE. You thought volume drove price. Why is it going up? Remember, volume doesn't drive price. Supply and demand drives price. If you have greater supply than demand, the price will fall. If you have greater demand than supply, the price will rise. You can be in a low supply environment or a low demand environment, but if you still have greater than one or the other, the price will go in that direction. So on INVE, I personally think it's a case of, yes, there's low demand, but there's even lower supply, so the price is still rising. Any other questions? All right, guys, thank you. Of course, you're welcome. Happy to do it. Thank you guys for being members and allowing me to have somebody listen to me. All right, guys, and the next webinar will probably be in the next 2 weeks or so. We'll definitely have one before July 4th, before the July 4th holiday. All right, thanks, guys, and sorry to those of you whose questions I didn't answer, but again, you know, can't go over stuff that wasn't submitted to me ahead of time. It's just not fair to do it for some people but not others. This was recorded, and it will be posted to my YouTube channel.